Alrighty. Hello, everybody. Welcome. My name is Rosalie. I'm the host of the Future of Derivatives podcast. I work at Panoptic. Thank you, everybody, for joining me today. I'm here today with some really lovely guests. Nathan's here from Panoptic, Joshua from FalconX, and Chris from Ergonia. So thank you so much for joining me today. I hope you guys are having a good Wednesday. And yeah, since we don't have a lot of time, I'd love to just dive right in. Everybody, please introduce yourselves, give a tiny little bit of background, maybe a fun fact about yourself, and we'll get started with some fun interview questions.
Hey everyone, my name is Joshua Lim. I'm the co-head of markets at FalconX. So FalconX is a global prime broker focused exclusively on crypto assets, and we service a lot of the crypto native hedge funds, but a lot of the newer entrants in the space are TradFi firms that trade crypto amongst a wide variety of other asset classes. And as we all know, crypto has really expanded its repertoire as well to include things like DATs and ETFs and CME listed products and things like that over the years. And so we're also active in all of those categories. We provide electronic liquidity, OTC liquidity, and we do a lot of trading, I think relevant for this particular podcast, on chain as well, on venues like Hyperliquid, but also things like Panoptic and Derive and other sort of venues that support optionality on chain.
Cool. And then, so I'm Chris Newhouse. I'm over at Ergonia. We're a DeFi-focused prop trading firm backed by DRW and Cumberland. Massively active. Roots come from Solana. So we're doing a massive amount of spot liquidity quoting there. We are, I'm the head of business development. So I kind of lead the client-facing DeFi business. And what that means for us is everything from on-chain token market making, leveraging some of our prop AMMs, to managing Orca, Meteor, Radium pools, doing things on HIP3, doing things with LSTs, doing some stablecoin distribution things, literally anything DeFi we're able to do. Relatively chain agnostic, but the top three chains for us are obviously going to be Hyperliquid, Solana, and then most likely Monad. Previously to Ergonia, there was an entity called Cumberland Labs, which merged into Ergonia, and Cumberland Labs incubated Purple Trade. So we'll be heavily active across Monad, Solana, Hyperliquid, anything DeFi we're able to do. So yeah. Fun fact as well, I was Josh's intern back in the day, 2021. So that's the career's come full circle now. Josh and I are on a panel together.
Yeah, it's basically a lifetime in crypto. Exactly. 4 years.
Awesome. Nathan, do you want to say anything as well before we start, or?
Oh yeah, just happy to get the second episode underway of this podcast. It's going to be interesting to merge these perspectives. He was your intern or Chris, you were his intern at Genesis, correct?
Yes, back in the day, 2021.
Wow, yeah. Fun. Yeah, I hear you talking about Monad as well. A big new chain launching, hopefully very, very soon. Super exciting. Yeah, I guess you guys have worked in different areas of DeFi and OTC trading desks and everything. And I'm really curious to see, what do you guys think people are really looking for right now in terms of trading? Do you think people are looking for more advanced trades, volatility trades? How does it differ, kind of what people are looking for in DeFi versus what people are looking for in TradFi?
Yeah, I can start. I mean, the fact that our industry has mashed so aggressively into traditional markets means I think the inbound that we see is a lot more kind of cross asset, and people are basically trying to find opportunities that exist between on-chain venues and crypto native venues, like the kind of the exchanges that are funded in crypto and are used by a lot of the crypto native market participants like Deribit and Binance and OKX, and trying to arb them against like more traditional venues, and we've already seen how much the growth of the ETF options like IBIT and ETHA options has really affected vol markets in crypto broadly, right? It's generally contributing to like vols getting more compressed. I guess more accurately, risk premia getting compressed as there's more supply on Bitcoin vol. You've also seen things like these overriding ETFs that have emerged, and they're constantly supplying vol into Bitcoin, but also on assets like MicroStrategy, which is a good proxy for Bitcoin as well. So yeah, we were talking to people generally who are trying to put on different trades there. Obviously, the basis trade still very much something that's top of mind for people. That's like a little bit less risky and adventurous way to get into crypto and sort of extract some of the yield and the appetite for leverage that exists in crypto. But obviously that trade is like, it's a very well-mined trade. There's things like Athena that do this systematically, and it's really very only very momentarily topical. It's sort of like when price action's very hot, then basis expands, and then people put it on. But yeah, that's sort of the range. I mean, in the very short run, it's a lot of hedging right now. Yeah, the break below 100K is really impacting like a lot of the crypto native market participants. It's just a lot of people that are generally underwater, right? Like Bitcoin is performing better than a lot of like the vast majority of altcoins, which are down 80-90% off the highs. So it's been harder and harder to kind of like outperform just a long only Bitcoin strategy, and hence people are doing a lot more hedging or de-risking, even things like putting on forwards on their altcoin portfolios, like short forwards, basically like trying to kind of lock in prices and preserve some value for LPs and things like that. So yeah, that's kind of the general sense of what we're seeing right now.
And then in terms of kind of like the, I'd say probably from the Protail and DeFi perspective, we definitely seen a lot of activity, of course, obviously with some of the exploits and things that have, gone on with Compound and some other stuff on DeFi, as well as kind of like what the Vault curation business starts to look like now in terms of some of the stablecoin, Morpho style curators. Like there's been a lot of interest just talking as a firm and to other people about kind of what is going on in the Vault curation landscape, the DeFi business, et cetera, specifically for stablecoins. Another thing that obviously over the past couple of months, probably starting in September, obviously, literally everyone wants to build a perp dex. And so everyone's got the points programs and people are farming, et cetera, obviously trying to replicate the success of Hyperliquid, Airdrop, et cetera, and things like that back in the day. So one of the, some of the activity that we've seen there is kind of just, points farming activity, volume-based trading, things like that. In terms of kind of like the Solana spot markets, obviously, I think we'll probably talk about this later as well, is a lot of the stuff that you can execute and do on Solana DeFi, it's definitely being augmented by some of the infrastructure and tech that's built out specifically for the market microstructure there. So the prop AMM stuff, I'm sure you've seen things like Zcash and some of these other kind of assets wanting to come on chain and be traded on Solana. A lot of the prop AMMs and some of the operators there are definitely facilitating a lot of that flow, obviously, especially a lot on the spot side. And so, yeah, I think in terms of kind of like a summary here, there's obviously been a massive amount of activity just on perp dexes in general, Solana spot activity with kind of like the narrative of, okay, let's bring some new stuff on chain. Let's do some RWA stuff on chain, et cetera. And then also kind of just overall landscape of what's going on in terms of how to generate yield on stable coins and potentially some of the LSTs coming up as well. Would say like a good summary there.
And really, as you mentioned, Josh, 4 years is a lifetime in crypto. How would you say the ecosystem has shifted in terms of gauging those flows and how to capitalize on them in that span of time? Because the ecosystem has shifted so much, and you guys were Genesis together. I'm interested to hear both of your perspectives on, is it easier now to spot that edge because of this range of products like the IBIT you mentioned? The market participants have shifted with these call overriding programs like from DATS and whatnot. Or would you say it's more difficult because, like, say, the basis trade has been so exhausted at this point?
I mean, I would say, yeah, the market structure is definitely like deepened and become more commoditized, right? Like, I think everyone kind of provides the same range of services. I think when Chris and I were at our previous trading shop, it was there weren't that many centralized dealing desks that had like balance sheet and could actually risk manage and price even vanilla options, right, in large size. So that was like an edge, and now the edge is like, can you price and model more complex products that have different kinds of optionality embedded in it, and can you price things on less liquid assets? Can you properly risk manage those positions? It's it's no longer like a market that has an active retail kind of retail originated liquidity, I would say, right? Because a lot of that flow has just left crypto entirely, right? The cycle feels very different than the previous cycle. It's a lot of the retail speculation is now on equities and other asset classes. So it really is a lot more PvP in some ways. Where there is still net inflows year to date is just on the majors, really, right? A lot of it's coming from the DATs and from the ETFs. So there is edge there. Like we touched on briefly all these different forms of correlated instruments on Bitcoin. That's certainly one area where maybe crypto native participants still have an edge. You can, if you can touch these sort of on-chain sources of yield, on-chain derivative markets, although even that's sort of compressing too, right? Like a lot of traditional players are getting a lot more comfortable in this regulatory environment to just participate directly on chain themselves. So I think that's, it's just a natural part of the asset, life cycle, market life cycle, where it's we're at a phase where everything is becoming more accessible to TradFi market participants. I think this happens every cycle too, right? Where we've sort of reached a peak in terms of price action and also in terms of market sentiment and sort of like mind share of crypto. Maybe we're past the peak at that, at this point. So it remains to be seen like how much the TradFi community will stay in crypto if there is a substantial and prolonged pullback in crypto prices. We've seen like in previous cycles, people generally exit, right, when there's no longer any interest and there's no retail capital and there's no inflows and things like that. So yeah.
Yeah, quickly to tack onto that as well. So previously, I mean, whenever I was a GSR, like the edge was literally just, will you quote this for some of the altcoin options? And so that was something back in 2021, 2022. I remember like, okay, like, hey, we're going to chart, like you could drive a truck through the spread. But back then as well, like a lot of the flow was relatively price sensitive, right? Like you had the treasuries who were kind of like, wanting to just sell covered calls. You had people who, not necessarily were the most sophisticated vol traders, but looking for ways to leverage up their position without having to use perps. They wanted to go through an OTC desk, et cetera, et cetera. And so back in 2022, like the edge was literally, will you just quote this on this top 100 asset for an option that's expiring in 30 days? Maybe the vol spread's absolutely massive, but there were still people willing to hit your bid or lift your offer there. And so that was definitely something that I saw in terms of like the nuances and development of edge over time. Is kind of like, just back then it's, will you quote it? Now everyone kind of quotes a lot of this stuff. Like Josh said, like the drive and demand towards more complex products in terms of structured payouts and things like that, and even more things that get bespoke on DeFi. That's something to where I've seen like the edge kind of develop as well in terms of like, okay, it's gone from will you quote this to, okay, a lot of people will quote this. What else can you do now? Is what I've seen.
That's very interesting. Big shift. I'm curious to hear more about, Chris, if you agree that like retail has kind of left DeFi a little bit more recently. I'm sure it looks very different on Solana. I'm also curious to to see like, does this really mean that now is like the time for options protocols to take off? At Panoptic, we're looking to kind of relaunch and rebuild with structured vaults and structured products. And so that, it'll make it easier for retail. It'll be like, you just deposit, the strategy happens on the back end. But that sounds a little bit risky for institutions, right? They kind of want to manage this themselves and not trust a vault manager. And so kind of balancing this edge between retail and institutional investors is really interesting. I'm curious to hear your thoughts, both of you, on that.
Yeah, in terms of kind of like the Solana retail activity, obviously that definitely peaked probably, Q4 24, Q1 25. You saw a massive amount of activity on the spot side with meme coins. You saw a massive amount of activity, fees being generated with Pump.Fund. You saw everyone kind of launching their own meme coins. You saw, presidents launching the meme coins. You saw influencers, KOLs. You saw everyone doing it. In terms of kind of like how that, I actually think that it's always like, okay, was this good or bad for the Solana ecosystem? In fact, the matter was like, from my perspective, there has been so many kind of like market structured shifts that came off the back of that retail activity in terms of professional trading tooling, pro-tail trading tooling, the prop AMMs. Like there was so much in terms of market microstructure development on Solana that came off the back of that I always think I kind of thought it was pretty bullish for the ecosystem, even though like obviously there's a lot of, rugs and scams and things like that, which everyone is relatively skeptical about in crypto. I do think that whenever you have a massive cycle that is driven by speculation like that, there's typically going to be some sort of, strong infrastructure play or some sort of strong tech focused, growth that happens off the back end of that. And you could definitely see that in 2025. So from my perspective, in terms of is retail still here? I mean, it really depends on how you kind of want to structure and segment that. In terms of what you just described with vaults, that's something that is definitely interesting to us. Ergonia is definitely going to be a vault strategist, vault curator in the future. We're entering that business right now. And so from our perspective of what you just said, like institutions don't really want, a protocol managing that. They're probably not going to deposit into that. That's true. We probably would not do that, but we would be happy to be the firm to help facilitate some of those structures and some of those strategies on the back end. In terms of kind of like depositing and retail and the interest, like from my perspective as well, it's always about how can you get safe. Okay, I don't want to say safe, but kind of like organic yield on DeFi that is also combined with strong incentive programs from some of these protocols. And a vault makes it really, really easy because these protocols can just drive incentives directly to the vault. You can maybe compound or double dip with the foundations, et cetera, et cetera. And so from my perspective of kind of like what DeFi looks like and pro LPing looks like in the next probably 1 to 3 years, I actually kind of like the vault stuff. And then to answer your question in terms of like retail activity on Solana, I still think it's relatively there, but not necessarily directly on Solana spot. Like maybe those Solana, meme coin traders from Q1 of 25 are still here, but maybe they're doing hyperliquid perps now. Those people are still definitely here. Speculation is still definitely strong. People are interested in prediction markets, et cetera, et cetera. And so, yeah, that's kind of my, perspective there on Solana spot, as well as kind of the vault market microstructure there.
Yep. I would say too, is like one major difference in this cycle versus last cycle is a lot of the innovation, I think last cycle was happening off chain. I mean, innovation or financial engineering or, whatever, shadow banking, whatever you want to call it, right? Like a lot of like leverage effectively and structuring and things like that were happening through like centralized intermediaries. And some of it was good in the sense that it was housed in regulated fund structures, right? That were there was oversight from the SEC for an RIA or the CFTC for a CPO or something like that, right? What's interesting is like this cycle, a lot of these active strategies, even some of the more passive, like systematic ones, are moving into effectively like tokenized format, like tokenized wrappers, right? And they could be in the form of like these stable value type products that, we've seen a lot of them that are quote unquote on the safer side because they're just purely basis trades and the segregated collateral and the off exchange and stuff like that. But it just happens every cycle, right? Like people go further and further out on the risk spectrum, and now there are a lot more complex products that are tokenized strategies, and there are pools where you can then borrow against those strategies and lever it up to get higher returns and things like that. And I do feel like we're in the point in the cycle where we do need to be like very, very hyper aware of the leverage that's being built up in the sort of like looping strategies on chain. And this was leverage that previously was maybe not as much on chain and was previously going through like the lending platforms and centralized dealing desks and things like that. And now it's pretty openly on chain, but I think maybe with even less oversight than before, right? It's less regulated, and there's a lot less transparency on what these strategies are doing. We've already seen a couple of these materialize where you've had stablecoins like DPEG or stablecoins. It turns out, deposit, basically like on lending to other protocols, or basically generating yield in ways that ultimately cause real impairment to depositors. And so it's concerning, but I'm sure it's like we're kind of at the early stages of actually finding out, all the different kind of layers that are happening in DeFi.
To piggyback off of that, there's the ever-present, because of this shift in market segment participation from retail to institutional or to pro-tail. How do you feel the ever-present debate is progressing in market structure as far as CLOBs versus AMMs versus RFQs, and now prop AMMs, which in my view are just on-chain dark pools to a certain degree. So how do you feel that as what mechanism do you feel has the most momentum currently for both of you?
Yeah, from my perspective on Solana, it's definitely driven by a lot of the prop AMMs. And in terms of calling it kind of like dark pool or dark AMM, I guess whenever people refer to it that way, it's more so dark in the sense that the execution logic as well as the pricing mechanisms are not necessarily visible to others. I wouldn't necessarily call it like too directly analogous to a dark pool in traditional finance. Essentially, like what the prop AMMs are is kind of like a vault-based liquidity provision mechanism for a professional institution or market maker to manage the pricing and execution logic on the back end. Essentially, there's a massive amount of inventory in this, and it's directly plugged into Jupiter or an aggregator. And the reason this works so well on Jupiter and on Solana is specifically one, because of the L1 blockchain Solana itself and how they actually prioritize fees per compute unit for Oracle price updates, as well as kind of like the fact that the Solana market microstructure is very aggregator dominant. On EVM and some other chains, I think like an actual decent amount of flow still goes through some of the front ends, still goes through some of the CLOB dexes, still goes through Uniswap, stuff like that. But on Solana, it is massively driven by aggregators, as well as like the benefits of some of building on the L1 blockchain for these prop AMM operators. Like one of the most interesting and coolest things is that you can actually get deeper liquidity on Solana spot, like Sol USDC pair on Jupiter is deeper liquidity than Binance, from what I can tell, up to a massive amount of size. And so what you actually see in terms of risk off and things like that is, honestly, whenever you track some of the P&L of these prop AMMs as well from the market makers, they might not necessarily be making, the most money. It's competitive right now. It's essentially kind of like 6+ different market makers competing for the same non-toxic flow. And the reason that this market structure is like so interesting is because you can literally choose to compete for only the non-toxic flow. Whenever a swap goes through Jupiter, you can literally see like, okay, before the swap actually executes, like what does the trade pattern look like? Is it like weird sizing? Is it weird timing, statistical arb patterns, like things like that? What does our current inventory position looks like? Is our Oracle price fresh enough to quote? You essentially have all these different kind of protections in place before you even quote. And so one of the coolest things is you essentially you pretty much have like 6 professional, market makers and operators of these prop AMMs all competing for non-toxic flow, bidding it down to zero. You're seeing like some insanely deep markets for like 1 BIP on Sol USDC and stuff like that. And at that point, it's not necessarily, predominantly driving P&L and edge, but one of the biggest things is like a lot of market makers are using this as risk off, like being able to get rid of Sol risk and things like that on chain. Historically, I guess in terms of like what I think is like the most predominant, I actually think all 3 of these things can exist: CLOB, AMMs, and prop AMMs. I think that AMMs are obviously like very, very good for, new assets, things like that. Typically like the meme coins, whenever there's no CeFi perp to hedge against, whenever there's no CeFi listings, like the AMMs will give you small liquidity and size or liquidity for some of those new assets. CLOBs is obviously like every market maker is very familiar with that. You can kind of post visible, takeable liquidity, et cetera, et cetera. And then the prop AMMs, there's relatively like strong market maker protections that just allow very, very quote tighting. So in terms of kind of like how you think about it, do you want the best execution or do you want like a venue for price discovery? And I think that prop AMMs drives best execution. CLOBs might be a little bit better for price discovery. AMMs are there for some of the tail assets. And I'll let Josh as well.
Oh, Josh, you're muted.
You might be muted.
Sorry. Yeah, I agree with that. Like I generally think like the AMM model is better for longer tail assets, but also for longer tail venues, right? So like as new venues spin up, like it's a lot easier to operate with like a liquidity pool where somebody's either managing it or it's trading versus like the pool itself according to some algorithm. Not always the most effective return for LP, like people LPing into it, but it is good for bootstrapping liquidity for a new venue. This is different than obviously what Chris is talking about for prop AMMs, which are effectively just like RFQing dealers off chain. But the sort of model like Hyperliquid and others have used to kind of bootstrap liquidity, and then in the long run, once a market is sufficiently large enough and there's a lot of takers and there's actual edge to be captured, I think that's where you have a lot of market makers come in and participate on central limit order book. So I think that's where every venue is going to make that transition at some point. I don't think there could be a long-term successful venue that doesn't have like an order book structure if it's at scale.
Interesting. Okay. And do you think that kind of with this, there's a lot of liquidity fragmentation as well. You mentioned hedging earlier. So how kind of are institutions handling hedging in these more fragmented markets, and how are we tackling this problem of liquidity? Do you think the solution is going to be order books first, or what does that look like?
Yeah, I mean, well, just in terms of like raw customer flows, there's just a ton of demand for downside and wings and just sort of like tail risk protection these days. And you touched on this earlier, but post some of the events that happened in October, there has been a lot of shift in attitude towards options. Like people now view them as like an actual useful toolkit to hedge their risk and their portfolios, right? I think before people would go with the old saying like, hey, retail's for crypto, all everyone cares about is perps, right? Because that's a lot more intuitive and it's a lot easier for retail to get a grasp on and trade and track P&L for. But nowadays, like because the mix has become much more institutional and those shops are very familiar with how to manage options risk and now are seeing like the actual benefits of having limited loss positions instead of open-ended kind of potentially ruinous like downside from having like auto liquidations on exchanges and perps. Like that's become a much more like feasible way to kind of trade and manage their portfolios. And I'm sure Chris is seeing it on his end, but it's resulted in like a pickup in our bilateral trading activity through our swap dealer, which is as a regulated entity, so people have a degree of comfort facing that. CME, is another venue that's like highly regulated, or the IBIT options. I think there's a migration towards like greater trust venues and maybe away from other venues that have less transparency or maybe a little bit less certainty about their liquidation and margin engines.
Yeah, completely agree with all what Josh said there. And then specifically in DeFi, like obviously after the Compound X point and some of the stuff with the stable coin as collateral and things like that, definitely saw kind of an exodus of some of the capital within DeFi. And so relatively, obviously kind of agree here on the CeFi piece, and then on the DeFi, relative exodus of capital across some of the stable coin things, people fleeing to a little bit safer opportunities and things of that nature. Yeah.
Awesome. Nathan, do you have any questions you wanted to ask before we kind of finish? I know this podcast is a little bit shorter than the other ones, but yeah.
No, I could keep this going for an hour or another hour if I wanted to. So I'm just keeping my questions. I'll ask offline if I have any more, but I wanted to be respectful of everybody's time.
Awesome. Yeah. I think the last question I would love to ask is just kind of like, well, what you think the next big thing is going to be in DeFi, or if you think this kind of always looking for the next big thing trend is finally over, and we're going to just kind of focus on risk management, calming down a little bit, and yeah, maybe Monad or something else.
Chris, you want to go?
Yeah, from my perspective, I guess next big thing, like I kind of definitely agree. Things seem to be relatively slowing down. People are trading perps, people are trading options, people are trading what they know. They're depositing into DeFi pools that they're familiar with and that they know. In terms of kind of like things that are interesting narratives that people are really pushing, is definitely kind of the RWAs and tokenized stocks and things like that. But I don't necessarily think that traction has really picked up over this probably year or quarter or anything like that to justify saying that that's a new and shiny thing. It's a narrative for sure, but not necessarily something that is like massively, oh my gosh, like every retail person should be trading like Tesla stock on Solana now, going through Jupiter, Prop AMMs. I don't necessarily think that. And so honestly, from my perspective right now, Q4, probably the first half of 2026, I really do think it's just people are trading perps, people are trading options, people are trading some of the new stuff in traditional markets as well. It's just normal right now. There's no new DeFi primitives going crazy and picking up traction, et cetera, et cetera. Obviously, like everyone talks about prediction markets and things like that. I still think that that is obviously a narrative that's very interesting. But right now, I think everything is kind of just normal is what I would say. Yeah.
Yeah. I think for me, like the most striking idea that's I've seen implemented in the last couple months has been around futarchy. So using prediction markets for governance, or some people call them impact markets as well. Like basically staking assets and then using it to trade like alternative outcomes that might happen from a decision point. And that's actually a very powerful idea. I think it's really cool that you can leverage like crypto concepts in implementing it, by locking up assets, creating sort of like decentralized markets around these things. I really hope like more founders pick this idea up and try to build something that gets as much kind of consumer adoption and traction as like Polymarket and Kalshi have. So yeah, it's something we're really paying attention to here as maybe like another interesting, it could be one of these things where it turns out to be like a more of a VC pipe dream type thing, but we think it's like a very, very interesting concept, at least from a theoretical perspective, and hope more people kind of get involved in that.
Awesome. Okay. Well, anybody listening, if you're building this, reach out to Josh. Awesome. Yeah. Thank you so much for your time today and coming onto this podcast and answering some of our questions. We really appreciate it. And yeah, thank you to everybody listening. I hope you enjoyed this episode, and stay tuned for another one after Thanksgiving.
Awesome. Thanks for having me.
Thanks, guys.
Cool.
Bye.
Thanks.